Imagine coming home from a really long, just exhausting day, and you walk in to find your roommate has completely rearranged your entire kitchen.
Oh, no! That is a nightmare scenario right there.
Right. I mean, your coffee mugs are totally gone from their usual cabinet. They've been replaced by, like, an assortment of exotic spices.
Naturally.
Yeah, and the spoons have been swapped with dish towels.
Hmm.
And then slapped right in the middle of the refrigerator, there's just this sticky note, and it simply reads, "Moved things wherever necessary."
Wow. That's incredibly annoying.
It's beyond annoying. You're just standing there in your own kitchen, totally terrorized, because you literally have no idea where anything is.
You can't even make a cup of coffee to deal with the stress of the situation.
Exactly. Now, I want you, the listener, to scale that feeling up. Imagine that kitchen is actually a billion-dollar corporate balance sheet.
Right?
Imagine those coffee mugs we're talking about are your life savings or, your pension fund or your firm's critical investment portfolio.
The stakes go up just a little bit.
Just a little. And imagine that instead of a passive-aggressive roommate, it's a massive listed company telling you they just move the numbers around wherever necessary.
Yeah, that changes the tone completely.
It really does. So today, we are going to explore why that exact scenario is not just incredibly frustrating for an analyst. It's actually a critical breakdown in financial architecture. Welcome, everyone, to a brand new deep dive on the Gap Advisors Ind AS Clinic podcast.
It's a perfect analogy to start with, honestly, because it immediately establishes the stakes for you. We're not just talking about, formatting preferences today.
Right, not all.
We are talking about the fundamental architecture of trust in the capital markets. When an investor or an auditor encounters a statement like that, the entire analytical process just grinds to a halt.
It has to, right?
Right.
And if you are an auditor listening to this right now and you just casually sign off on a wherever necessary note without demanding the proper trail of evidence, well, you are the one who is suddenly liable.
Absolutely. You are endorsing obscured, potentially very dangerous data.
And that is our mission for today's deep dive. We are going to take a single, seemingly harmless sentence that was found in a real company's published financial statements, and we are going to unpack it.
Unpack it and see how it accidentally triggers just a massive, fascinating lesson on transparency.
Yes. Transparency, the mechanics of communication, and the incredibly strict rules that actually govern accounting standards.
It really is kind of the ultimate case study in how a few poorly chosen words can violate the absolute core philosophy of financial reporting.
It really is.
But before we get into the heavy mechanics of financial disclosures and regulatory frameworks, we do need to lay down the absolute ground rules for today's discussion.
Right, the baseline context so everyone is on the same page.
Exactly. We want to ensure that you, the listener, are operating with the exact same baseline of facts that we are. So, for the purposes of everything we are analyzing today, we are operating under the assumption that both the functional currency and the presentation currency is the Indian rupee.
Okay, so we are dealing strictly in Indian rupees as our baseline.
Correct. Therefore, any currency that is not the functional currency, meaning, anything other than the Indian rupee, is technically considered a foreign currency under this specific framework.
Got it. And what about the timeline?
Right, the timeline. The reporting period we are scrutinizing today begins on the 1st of April and ends on the 31st of March. That is our temporal boundary.
So Indian rupee and a standard April to March financial year. Makes perfect sense.
And as is standard practice, when we delve into these highly technical, high-stakes regulatory environments, we must provide our mandatory disclaimer.
Oh, yes. The lawyers would be very upset if we forgot this part.
They absolutely would. So here it is. The views expressed in this deep dive are the personal views of the author of our source material, and they are absolutely not binding on you, the audience.
Right. It's educational.
Exactly. You are strongly requested to seek the help of a professional expert before taking any action or, refraining from any action based on the views we are discussing herein. We are dissecting the mechanics, but applied knowledge in the real world requires careful, individualized expert consideration.
Well said.
Oh.
Okay, so let's establish the origin of our target for today. Where exactly did we find this single chaotic sentence that we are dedicating an entire deep dive to?
It's a great source, actually.
It is. This specific observation comes to us directly from the 225th edition of the Gap Advisors Task Weekly newsletter.
That's correct. And for those professionals listening who might not yet be familiar with this resource, this incredibly detailed newsletter is authored by C.A. Manish C. Iyer.
Who is the director of Gap Advisors.
Yes, the director. And
Yeah.
he publishes this crucial analysis directly on LinkedIn. And what is truly impressive about it, and honestly what makes it such a vital resource for the entire financial community, is the sheer volume of knowledge being shared there.
It's massive. Over 230 editions have been published to date, right?
Over 230 editions, yes. If you are on LinkedIn, and, well, I mean, if you are in finance, you certainly are, I highly encourage you to subscribe to the newsletter.
Yeah, it's a no-brainer.
It really is. It's available completely for free, and it consistently highlights these vital, often overlooked nuances in financial reporting that can literally make or break an audit.
All right, so we have the newsletter, we have our context, and we have our target, a published set of Ind AS financial statements from an actual listed company.
A real company.
A real company. But how this sentence was discovered is almost as important as the sentence itself, I think.
Oh, completely.
Because this wasn't flagged by a government regulator issuing a penalty, right?
Yeah.
And it wasn't caught by some disgruntled institutional investor throwing a fit at an annual general meeting.
No, not at all.
All financial statements were downloaded and independently reviewed by Gap advisors on a suo moto basis.
Suo moto, meaning entirely on their own motion.
Right. They just went out and looked for it.
Exactly. They proactively went out, pulled the publicly available data, and just subjected it to rigorous scrutiny. And honestly, this highlights a massive blind spot in the industry.
It really does show how incredibly easy it is for problematic disclosures to slip right through the cracks.
Oh, it's so easy. Especially when management and their auditors are deep in the trenches, racing against publishing deadlines. Everyone is tired, everyone is stressed.
Yeah, they just want to get it out the door.
Right, and this is precisely why it is so highly recommended to get your financial statements reviewed by an independent, objective party like Gap Advisors before you sign them.
Because once you sign your name, the liability is entirely yours.
It's yours, it's out there.
It's the equivalent of having a brilliant, ruthless editor look at your manuscript before you send it to the publisher. Because once it is out there in the public domain, well, the bell has been rung. You just can't unring it.
Precisely. And establishing that safeguard is actually an incredibly straightforward process.
How does it work?
Anyone preparing these documents, whether you are a CFO, a controller, or, an engagement partner, can submit their financial statements in a near-to-publishing PDF format via email directly to info@gopadvisors.com.
That's super easy. info@gopadvisors.com.
Very easy. It is a proactive defense mechanism that can absolutely prevent the exact, highly problematic scenario we are about to dissect today.
Let's get the patient on the operating table then. Let's look at the actual quote. This listed company, bury in the notes of their published finalized financial statements, disclosed the following sentence.
Here we go.
Quote, previous period/year figures have been restated, regrouped, and rearranged wherever necessary. Unquote.
I mean, it carries such an air of administrative routine, doesn't it? It sounds almost completely benign if you read it quickly.
It really does.
Yeah.
If you are skimming a 200-page annual report, your eyes just graze right over that. It sounds like they're just doing basic housekeeping.
Just tidying up the kitchen.
Exactly.
Yeah.
But I have to stop right there and look at the actual words. Restated, regrouped, and rearranged wherever necessary. Going back to my kitchen analogy, if my roommate says they moved my things wherever necessary, I am left totally in the dark.
Totally in the dark.
Isn't this company doing exactly that to the market? They are saying, hey, those comparative numbers you relied on last year to build your valuation models, we moved them around. Where did we put them? Don't worry about it. Why did we move them? Well, because management felt it was necessary.
Yeah, just trust us.
Right. How is that legally permissible in a highly regulated market?
Well, the short answer is it isn't permissible. And your frustration is exactly the intended reaction of a vigilant primary user.
Okay, so I'm right to be mad.
You are very right to be mad. To understand why this sentence is so deeply problematic, we really have to look past the surface-level annoyance and examine the core mechanical philosophy of financial reporting.
Which is what...
Well, knowledge, especially financial data, is only valuable when it can be accurately understood, contextualized, and applied by the person reading it. Financial statements are not some internal diary for a company to keep its own secrets.
Right, it's not a private journal.
Exactly. Or a place to casually jot down administrative whims. They are a highly structured communication tool designed explicitly for primary users, investors, creditors, analysts, and
And
regulators.
a vague, sweeping statement like wherever necessary immediately raises a massive red flag.
A huge red flag,
Right.
because it completely severs the fundamental contract of transparency between the entity and the public markets.
But let me push back a bit because I really want to understand the mechanics of why companies actually do this in the real world.
Sure, play devil's advocate.
If I'm drafting a financial statement, I'm dealing with thousands of line items. Maybe a new accountant came in and decided that office supplies should now go under administrative expenses instead of miscellaneous expenses.
A very common scenario.
Right, and it's a tiny shift. It doesn't change the bottom line profit at all. So why shouldn't a company be allowed to just use a catch-all phrase like rearranged wherever necessary for minor housekeeping? If they had to explain every single 500 rupee shift, wouldn't these reports be thousands of pages long?
I hear that all the time. That is the exact argument companies use to justify this kind of boilerplate language. They claim it is purely an issue of practicality.
Sounds practical.
It does, but that defense fundamentally misunderstands the entire purpose of comparative analysis. When an analyst builds a financial model, they are looking for trends over time.
They need a stable baseline.
Yes. If a company silently shifts expenses between categories without leaving a clear trail, they corrupt the trend lines. What might look like an incredible efficiency gain in one department might actually just be an accounting reclassification.
Oh, wow. I didn't even think of that. They could manipulate the optics of their efficiency without changing the bottom line.
Absolutely. And to address your point about the reports becoming thousands of pages long, the accounting standards are actually quite pragmatic. They don't demand an essay for a 500 rupee shift. The standards operate heavily on the principle of materiality.
Right, if it's too small to matter, you don't need a 10-page note on it.
Exactly. But when a company uses a blanket statement like wherever necessary, they aren't claiming the shifts are immaterial. They are claiming the authority to make shifts of any size for any reason without providing the roadmap.
Ah.
And that brings us directly to the absolute authority on this matter, the rulebook itself.
Okay, let's open the rulebook. We are looking at Ind AS 1, which governs the presentation of financial statements. And specifically, our source material points us to paragraph 41.
Paragraph 41.
So what exactly does paragraph 41 demand of a company that wants to rearrange its financial kitchen?
Paragraph 41 is the ironclad rule governing the concept of reclassification. It states unambiguously that if an entity changes the presentation or classification of items in its financial statements, it shall reclassify comparative amounts.
Shall reclassify. That's a strong
It's
word.
very strong. It must reclassify comparative amounts, unless reclassification is entirely impracticable.
So just to translate that into operational terms for you listening, if you decide to change how you define or present a specific number this year, you are legally obligated to go back in time, apply that exact same new definition to last year's numbers, and present them side by side.
Yes, exactly.
You have to give the user a true, untainted apples-to-apples comparison.
Precisely. You cannot compare last year's operating revenue with this year's operating revenue if the internal definition of what constitutes that revenue has been secretly altered.
That would just be lying with math.
It would.
Yeah.
But paragraph 41 goes much deeper than just demanding the math be updated. It demands a narrative.
A narrative.
Yes.
Yeah.
It dictates that when an entity reclassifies these comparative amounts, it is legally required to disclose 3 highly specific parameters.
I have the text right in front of me, actually, and it is remarkably prescriptive. If you move the numbers, you must disclose A, the nature of the reclassification,
Yep.
B, the amount of each item or class of items that is reclassified,
Yep.
and C, the reason for the reclassification, nature, amount, and reason. It really is a detective's checklist.
It's the what, the how much, and the why.
Exactly. What exactly is the thing? What is the mathematical value of the thing? And what was the intellectual justification for moving the thing? But I need you to explain the mechanics here. Why are all 3 strictly required? What happens if a company gives you the amount, but they just, leave out the reason?
That is a phenomenal question, and it really gets to the heart of how financial analysis actually works in practice. Let's build a practical mechanical scenario.
I'll do it.
Imagine a manufacturing company. Let's call them Steel Corp. Let's say Steel Corp decides that a specific highly liquid short-term investment portfolio should now be classified under cash and cash equivalents on the balance sheet.
Instead of where it was last year.
Right. Last year it was under other current financial assets.
Okay, so they are basically sliding money from one bucket to another bucket that makes them look slightly more liquid.
Exactly. Now let's apply the 3 pillars of paragraph 41. The nature is the shift of this specific mutual fund portfolio from other current financial assets to cash and cash equivalents.
I got it.
The amount is, let's say, 500 million rupees. Now, if Steel Corp only gives you the nature and the amount, but omits the reason, the analyst is flying completely blind regarding the company's internal risk management.
But how so? I mean, the analyst knows the money move. They know it's 500 million rupees. Doesn't the math balance out perfectly on the spreadsheet?
The math balances, yes, but the context is destroyed. Why did they move it? Was it simply because the accounting standards changed?
Right, which would be totally benign.
Or was it because Steel Corp's board quietly changed the company's internal treasury policy, allowing them to take on far more risk with their quote-unquote cash equivalents?
Oh, wow.
If the reason is a change in treasury policy, that entirely alters how an analyst perceives the risk profile of that 500 million rupees.
Because it's not actually as safe as normal cash.
Exactly. Without the reason, the analyst assumes it's just a clerical update, completely missing a fundamental shift in corporate governance.
That is wild.
And conversely, think about what happens if they give the nature and the reason, but omit the amount.
They changed their treasury policy, but you have literally no idea if it affects 500 rupees or 500 million rupees. You can't adjust your valuation models because you just don't have the coefficient.
Exactly. And AS1 recognizes that the narrative and the mathematics are inextricably linked. It demands a complete architecture of disclosure.
It's not just moving numbers to make columns balance.
Not at all. It is about explaining the what, the how much, and the why, so that the primary user can accurately gauge the true economic reality of the business.
Man, this makes the sentence we found our target sentence look so much worse. The company just said things were restated, regrouped, and rearranged wherever necessary.
Yeah, it's pretty damning when you hold it up against the standard.
So let me ask you the definitive question based on our source material. Looking at the notes provided by this specific listed company, did they actually provide the nature, the amounts, and the reason in that specific introductory note?
No. The answer is a definitive, undeniable no. They completely and utterly failed to disclose the details required by paragraph 41 in that specific note.
Nothing at all.
Nothing. They stated that an action occurred, the regrouping and rearranging, but they provided absolutely zero narrative architecture, zero amounts, and zero justification to support it. They simply declared that the kitchen had been rearranged.
Okay, I am going to play devil's advocate here again, because if I am the CFO who signed off on this document, I am definitely not going down without a fight. I want to challenge this interpretation.
Bring it on. What's the CFO's defense?
If I am the CFO, I look at you and say, listen, you are taking one sentence entirely out of context. Sure, I didn't write a novel explaining the nature, amount, and reason in that specific introductory paragraph, but this is a 300-page annual report. If you just keep reading, maybe 85 pages later, buried deep in note 42 under a subheading about financial instruments, I actually did disclose the 500 million rupee amount. And maybe way over in note 16, under significant accounting policies, I vaguely alluded to the reason.
So your defense is that the pieces are all there.
Exactly. My defense is the information exists. I put all the ingredients in the report. It's not my fault if the analyst is too lazy to hunt them down. Isn't that a valid legal defense? The information is technically within the four corners of the document.
That is an incredibly common defense. In fact, it is the standard defense employed by entities when they are confronted with these kinds of structural deficiencies. They argue that as long as the data points exist somewhere within the massive volume of the published document, they have fulfilled their fiduciary duty to the public.
It sounds plausible.
It does, but your CFO defense forces us to pivot to the absolute philosophical core of today's deep dive. To dismantle that defense, we actually have to move beyond paragraph 41 and look at paragraph 7 of Ind AS 1.
Paragraph 7.
Yes. Paragraph 7 introduces one of the most profound, psychologically complex concepts in modern accounting, the concept of obscuring information.
Obscuring information.
Yeah.
Wow, that sounds a lot more aggressive than just poor formatting.
It is.
It sounds deliberate, like throwing up a smoke screen or jamming a radar signal.
It is an aggressive term, and the accounting standard wields it with incredible gravity. The standard does not view poor formatting as a victimless administrative error. Let me quote paragraph 7 directly because the wording is just breathtaking in its implications.
Go ahead.
It states, information is obscured if it is communicated in a way that would have a similar effect for primary users of financial statements to omitting or misstating that information.
Hold on. I need to pause and repeat that so the sheer weight of it really sinks in for everyone listening. The accounting standard legally dictates that obscuring information, just communicating it poorly or hiding it in a weird spot, has a similar effect to omitting it, which is hiding it completely, or misstating it, which is outright fraud and lying.
Yes.
It equates bad formatting with lying.
It absolutely does. And we need to deeply analyze why the standard draws that psychological and operational equivalence. And AS1 is fundamentally declaring that the method of delivery is just as critical as the data itself.
Right.
If you place information poorly or communicate it in a convoluted, fragmented way, the end result for the primary user is functionally identical to them never receiving the information at all.
Because they can't use it.
Exactly. They are making critical economic decisions based on a flawed, incomplete, or artificially distorted understanding of the company's reality.
This completely upends how most people view financial compliance. We are conditioned to think that corporate fraud is all about making up fake numbers, Enron-style fabrication. But this standard is saying that weaponized incompetence or weaponized complexity is just as dangerous as a fabricated spreadsheet.
It is, and honestly, in modern finance, it might be even more dangerous because it is so much harder to prosecute.
How so?
Let's look at the mechanical reality of how markets operate today. Financial analysis is no longer just a human being sitting at a desk with a calculator and a printed PDF. It is highly algorithmic.
Oh, right. The machines.
Yes. Analysts use automated scraping tools, natural language processing models, and complex APIs to pull year-over-year comparative data directly from these filings into their valuation models.
So the machines are doing the heavy lifting of data extraction.
Exactly. Now, what happens when an automated scraper hits a statement that says the comparative figures have been regrouped wherever necessary without any clear architectural link to the new locations?
The machine gets confused.
Worse than confused. The algorithm pulls a misaligned number. It pulls the old definition of operating expense and compares it to the new definition, completely unaware that the underlying nature of the number has actually changed.
Because it didn't read the subtle shift in Note 42.
Right. The algorithm then spits out a falsely inflated EBITDA, which triggers an automated buy rating on the stock.
Oh my God.
The obscuration didn't just confuse a human reader. It actively broke the financial model that the market relies on. This is exactly why paragraph 7 is so draconian. Transparency requires accessibility and structural integrity.
So if I hand you a 10,000-page book written in a complex cipher, I can stand in court and say, well, I gave you all the information. But paragraph 7 says, no, you obscured it so thoroughly that it is functionally useless, which means you lied.
Precisely. And to ensure that companies cannot just feign ignorance about what constitutes obscuring, the standard doesn't just leave it as a vague philosophical concept.
They give examples.
Yes. Paragraph 7 explicitly lists out 5 highly specific, real-world examples of circumstances that result in material information being obscured. These are the specific tactics that regulators are actively hunting for.
Okay, I want to spend serious time on these. Let's call them the 5 deadly sins of obscuring data. The source material outlines them as points A through E. I want us to really dissect the mechanics of each one.
Let's do it.
Let's start with the first deadly sin, point A. The standard says information is obscured if the item is disclosed, quote, but the language used is vague or unclear. Well, there's the smoking gun. Wherever necessary is the absolute poster child for vague and unclear language. It is the complete antithesis of precision. It's like asking a surgeon what they did during your operation, and they say, oh, we made incisions wherever necessary.
Yeah, you would probably sue that surgeon.
Immediately.
It is a complete abdication of responsibility. And let's look at the psychology of the primary user when they encounter that. For an analyst or an auditor, vague language destroys confidence instantly. It breeds skepticism.
Because you assume the worst.
Exactly. When a seasoned investor reads wherever necessary, they don't think, oh, the accounts are just trying to save some space on the page. They immediately think, what are they trying to hide? Why couldn't they be specific? Is there a catastrophic loss buried in this reclassification?
It makes everything look suspicious.
It forces the user to apply a risk discount to the entire financial statement because the baseline level of trust has been fractured.
It turns the financial statement from a source of truth into, like, a suspect under interrogation. Okay, moving to the second deadly sin, point B. Information is obscured if it is scattered throughout the financial statements.
This is a big one.
Now, this directly targets my devil's advocate CFO defense from earlier. The CFO who said, hey, the amount is in note 42 and the reason is in note 16. The standard explicitly says that is illegal. My analogy for this is like buying someone a 1,000-piece jigsaw puzzle, but instead of giving them the box, you drop 5 pieces under their sofa, you hide 20 in their bathtub, scatter 100 in the attic, and then you just mail the rest to their neighbor.
Good luck building that puzzle.
Exactly. Technically, they possess the puzzle.
Right.
Practically, it will never be assembled.
That is an incredibly apt visualization of the problem. Now, translate that bathtub and attic into the mechanics of a corporate disclosure. An institutional investor is analyzing, 50 different companies a week. They do not have the time, nor should they be expected, to embark on a forensic treasure hunt through a 300-page document just to piece together the fractured narrative of a single reclassification.
They just don't have the bandwidth.
If the amounts are isolated in Note 15, the reason is vaguely hinted at in Note 40, and the nature is buried in the management discussion and analysis section, the cognitive architecture is completely broken.
The human brain can't hold all that at once.
Right. The user cannot synthesize the variables simultaneously, which means they cannot make a fully informed economic decision. The information is scattered, and therefore, legally, it is obscured.
This brings us to the third and fourth deadly sins, points C and D. I want to look at these together because they really feel like two sides of the exact same deceptive coin.
They are very closely related.
Point C dictates that information is obscured if dissimilar items, transactions, or other events are inappropriately aggregated. And point D states it is obscured if similar items, transactions, or other events are inappropriately disaggregated.
Aggregation and disaggregation.
Let's start with inappropriate aggregation, grouping things that have no business being grouped. Give me a mechanical breakdown of how a company uses this to deceive the market.
Okay. Inappropriate aggregation is a classic mechanism for hiding highly toxic or embarrassing data. Let's use a real estate developer as an example.
Sure.
Suppose this developer has a massive, highly risky subsidiary loan that has just defaulted. It is a catastrophic multi-million rupee loss. If they disclose that loan default as a separate line item on the income statement, their stock price will just plummet.
Everyone will panic.
Everyone. So what do? They aggregate it. They take that massive, toxic loan default and lump it into a broadly defined line item called general and administrative expenses.
Wait, really?
Yes. A category which already contains their massive budgets for, office leases, software licenses, and employee travel.
Wow. So they just dilute the poison into the ocean of normal operating costs?
Exactly. They group entirely dissimilar items, a catastrophic financial default and routine operational overhead. To the primary user looking at the spreadsheet, it just looks like the company's administrative costs went up a bit this year, perhaps due to inflation.
They don't see the default at all.
They completely miss the systemic risk of the loan default because the specific nature of the toxic item has been chemically neutralized by inappropriate aggregation.
That is terrifyingly simple. And what about the reverse? Point D, inappropriate disaggregation, splitting similar things apart. How does a company weaponize that?
Well, disaggregation is used to avoid triggering materiality thresholds or to hide systemic patterns of failure. Imagine a heavy manufacturing company that continuously violates environmental regulations.
Okay.
Let's say they pollute a local river and get hit with a massive, unprecedented 50 million rupee regulatory fine from the government.
That's a huge hit.
Huge. If that single 50 million rupee fine appears as one line item, the board of directors and the ESG investors will demand an immediate overhaul of management.
Right. It's a giant glaring siren.
Exactly. So to silence the siren, the company disaggregates the fine. Instead of showing one 50 million rupee penalty, they break it down into 50 separate 1 million rupee line items, and they scatter them across different regional operating divisions under generic names.
Like what?
Things like site maintenance fee or local compliance assessment and operational surcharge.
That is incredibly devious.
It is, because when the analyst looks at the division-level data, A 1 million rupee site maintenance fee doesn't trigger any alarms. It just looks like the normal cost of doing business in that region.
Yeah, nobody questions $1 million in a billion-dollar company.
By inappropriately splitting a single systemic, highly material event into dozens of seemingly immaterial, unconnected fragments, the company completely obscures the massive environmental and regulatory liability hanging over their operations.
Which perfectly transitions us to the fifth and final deadly sin, point E. The standard states that information is obscured if the understandability of the financial statements is reduced as a result of material information being hidden by immaterial information to the extent that a primary user is unable to determine what information is material.
This is a very modern problem.
It is. I call this the terms and conditions defense, or, information overload as camouflage. We have all experienced this as consumers. You download a new piece of software, and before you can use it, you are hit with an 85-page, single-spaced, size 6 font user agreement.
Which nobody reads.
Nobody. Somewhere on page 62, there is one sentence that says the company owns the rights to all the photos on your phone. But because that one highly material sentence is buried under an absolute mountain of completely irrelevant, immaterial, legal boilerplate, you are fundamentally unable to determine what is actually important. You experience cognitive fatigue, you hit accept, and you just move on.
You have described the exact mechanism. In the corporate reporting world, this is often executed via the data dump.
The data dump. Yeah. If a company is forced to disclose a highly material, deeply unfavorable change to their revenue recognition policy, they know they can't omit it. That would be obvious fraud. So instead, they hide it in plain sight.
How do they do that?
They release a 600-page annual report. They take that one critical paragraph about the revenue policy and bury it in the middle of 40 pages of incredibly dense, totally routine, boilerplate accounting disclosures that haven't actually changed in 15 years.
They exhaust the reader on purpose?
Precisely. They weaponize the sheer volume of data to exhaust the primary user. The analyst is reading page after page of standard, unchanging definitions of inventory depreciation. Their eyes just glaze over and they skim right past the single paragraph that fundamentally alters the company's valuation.
And then the company can just claim, hey, we disclosed it.
Right, but under paragraph 7, point E, they deliberately obscure the material by drowning it in the immaterial. It is a direct violation of Ind AS 1. Okay, this has been an incredible masterclass in the mechanics of deception. We have laid out the entire legal and philosophical framework here.
We covered a lot of ground.
We really did. We have the strict rules of paragraph 41 demanding the nature, the amount, and the reason for any reclassification. And we have thoroughly dissected the 5 deadly sins of obscuring information under paragraph 7, from inappropriate aggregation of toxic loans to drowning material facts in an ocean of immaterial boilerplate.
It's quite a gauntlet.
Now, the time has come to bring all of this immense regulatory weight crashing down on our specific source material. Let's return to the company that initiated this entire deep dive. Let's pass judgment on their statement. Previous period/year figures have been restated, regrouped, and rearranged wherever necessary.
Let's apply the framework systematically. If we return to your earlier CFO defense, the idea that the company might have actually provided the amounts and reasons somewhere else in the document, just scattered across different notes. We can now definitively say that based on paragraph 7, example B, this defense is fundamentally flawed and legally invalid.
Right, the scattered puzzle pieces.
Exactly. The source material states the verdict perfectly. The information regarding the reclassification of items is scattered throughout the financial statements in the absence of a cross-reference. Therefore, the company has unequivocally disclosed information in the notes in an obscuring manner.
I want to zoom in on that exact phrase
Yeah.
because this is the absolute crux of the entire issue. In the absence of a cross-reference. It's not just that the puzzle pieces were in different rooms. It is that there was no map provided to the user.
That is the architectural failure.
It is mind-blowing how simple the solution is. A single, well-constructed sentence could have completely saved this company from violating Ind AS 1.
Just one sentence.
Right. If they had just written, previous period figures have been restated. Please see note 42 for the detailed nature, amounts, and specific operational reasons for these reclassifications. That is it. That one sentence provides the cross-reference. It provides the map to the scattered puzzle pieces. It completely neutralizes the accusation of obscuring data under paragraph 7b.
You have hit the absolute nail on the head. And if we connect this to the macro-level reality of corporate governance, this is the most profound lesson of today's deep dive.
Transparency isn't just about dumping data.
No, transparency in the modern financial ecosystem is not just about the mere existence of data points. It is about the architecture of that data. It is about how the data is logically connected, how it is intelligently signposted, and how accessible it is to the human being or the algorithmic model trying to parse it.
Because if it's not connected, it's useless.
Completely. By failing to provide the details in that specific introductory note, and crucially, by failing to provide a simple, functional cross-reference to where those details might exist elsewhere, the company functionally destroyed the utility of the information. They failed the primary users. They violated both the spirit and the strict letter of Ind AS 1.
It is wild how much professional liability rests on such incredibly small structural details. The massive difference between rigorous compliance and legally obscuring information can literally come down to a CFO remembering to type the words "See Note 42."
It really can.
But this brings up a massive, terrifying issue for the professionals actually on the ground doing this work. I want to talk directly to you, the listener, right now. Let's say you are an audit manager. You are preparing for a brutal 14-hour audit committee meeting.
We've all been there.
You are dealing with massive information overload, hundreds of pages of disclosures, and aggressive management teams pushing back on every single adjustment. How on earth are you supposed to keep track of all these microscopic, critical nuances?
It's incredibly difficult.
How do you spontaneously remember, in the heat of an argument with the CFO, that a missing cross-reference triggers a paragraph 7 violation regarding paragraph 41 of Ind AS 1? It feels like you would need an eidetic memory or a supercomputer integrated into your brain just to survive the audit season without taking on massive liability.
You are describing the exact intense pressure cooker that defines the modern audit profession. The sheer volume and complexity of the Indian accounting standards are staggering. It is impossible for any single human brain to perfectly recall the interplay of every paragraph and every subclause under pressure.
So what do they do?
Well, thankfully, professionals do not have to rely solely on their own memory or their own isolated interpretations of the text. There is an ultimate lifeline available, and it ties directly back to the very organization that proactively uncovered today's suo motu observation.
Yes. We need to talk about the resources at GAP Advisors.
For anyone navigating these treacherous regulatory waters, the issue repository hosted on the gapadvisors.com website is an absolute unparalleled goldmine of practical application.
It really is.
We are not just talking about textbook theory here. This repository currently hosts over 4,500 highly specific issues and their detailed, authoritative responses regarding both Ind AS and Indian GAAP. Think about the volume of knowledge that represents.
Over 4,500 real-world scenarios.
Real-world, complex scenarios that have been meticulously dissected and resolved by experts.
And what I find incredible is the sheer accessibility of this tool. This isn't locked behind some massive corporate paywall that only the big four firms can afford. Any person listening to this deep dive right now can register on the site completely for free.
Completely free.
You can literally go to gapadvisors.com, create your account, and instantly start submitting your own specific, agonizing issues or questions regarding Ind AS and Indian GAAP. And the best part is the delivery mechanism. You don't have to constantly check a portal. You receive a highly detailed expert response delivered directly to the inbox of the email you registered with.
It's so efficient.
It is an unbelievable mechanism for continuous, real-time professional learning.
It is. And if we elevate this and connect it to the bigger picture of professional risk management, this tool transitions from being merely educational to being a critical instrument for survival.
How so? Like mechanically.
Think about the specific liability auditors carry. Auditors need to formally, rigidly document exactly how they addressed and resolved any specific issue regarding the application of Ind AS during their audit process. If the regulatory body comes knocking 3 years later, the auditor needs to produce the working papers that prove their rationale.
Right. If it isn't documented, it didn't happen.
Exactly. Imagine an auditor encountering a vaguely worded, wherever necessary statement like the one we spent the last hour dissecting. Instead of getting into a subjective shouting match with the CFO, the auditor can utilize the GAP Advisors repository.
They just pulled a precedent.
Yes. They submit the specific disclosure issue. They receive the detailed, authoritative breakdown explicitly correcting the failure of paragraph 41 to the obscuration clauses of paragraph 7, and they place that expert response directly into their audit file.
Boom. Case closed.
They use it to firmly, objectively document their decision to challenge management's disclosure. It provides the independent, unassailable backing needed to enforce true transparency. It helps conscientious professionals ensure they don't make catastrophic mistakes. And it helps rigorous auditors prove on paper that they caught the companies that did.
It really is the ultimate cheat code for navigating the deeply muddy, incredibly dangerous waters of financial reporting.
Yay.
It completely takes the guesswork out of
It
compliance.
absolutely does.
So let's pull all of this together and recap the incredible journey we have been on today. We started with a highly relatable scenario of a roommate carelessly rearranging a kitchen. We scaled that up and discovered a massive listed company casually moving last year's critical comparative numbers wherever necessary.
A huge red flag.
We explored the unyielding mechanics of paragraph 41, which strictly demands the precise nature, the exact mathematical amount, and the strategic reason for any reclassification. We then dove deep into the psychology of deception, exploring the 5 deadly sins of obscuring data under paragraph 7.
From inappropriate aggregation to data dumps.
Right, exactly.
Yeah.
And finally, we learned that sometimes a simple, elegant cross-reference is the only structural pillar standing between a company's disclosure and a fundamentally flawed, legally invalid financial statement.
It truly has been a remarkable, expansive journey from dissecting a single, seemingly administrative sentence to uncovering the absolute core philosophy of financial communication.
It really has.
And as we finally wrap up this intensive deep dive, I want to leave you, the listener, with a final, highly provocative thought to mull over as you return to your own spreadsheets and audit files.
Oh, I love a good final thought. Let's hear it.
In our hypermodern era of endless data dumps, infinite cloud storage, and automated algorithmic scraping, we have more sheer access to raw numbers than at any prior point in human history. We are drowning in data. But this deep dive proves that an abundance of data does not inherently equal an abundance of clarity.
That is so true.
This raises a vital existential question for the profession. Is the true mark of corporate transparency no longer about how much information you provide to the market, but rather how intelligently, thoughtfully, and honestly you curate, signpost, and connect that information for the human mind trying to read it?
Wow. That is a phenomenal question to end on. It perfectly distills everything we talked about today. It's not about throwing all 1,000 puzzle pieces at the investor. It's about providing the picture on the front of the box and drawing a map to the pieces.
Exactly.
Thank you so much for joining us on this incredibly deep, fascinating journey today. To help us spread this vital, practical knowledge of Indian accounting standards across the industry, I have a massive favor to ask you. Please take a moment to share this podcast among your professional contacts, your industry colleagues, your audit and finance teams, and especially any students you know who are currently grinding through their CA course.
Yes, the students definitely need this.
This kind of deep, mechanical, analytical thinking is exactly the framework the next generation of financial professionals needs to master.
I couldn't agree more. The more deeply we all understand these subtle structural nuances, the stronger, more resilient, and more transparent our entire financial system becomes.
Thank you all once again for your valuable time and your focus today. We genuinely love taking these intensive deep dives with you. To make sure you never miss out on this level of analysis, please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on. Keep questioning the data, keep demanding transparency, keep learning, and we will see you on the next deep dive.